Welcome to The Outlet, where we keep you plugged in to everything energy. To lead the charge, here's your host, Tom Glanzer.
Well, welcome to The Outlet, NorthWestern Energy's podcast. We call it The Outlet. I'm your host, Tom Glanzer, and we are joined today. I get to go straight to the top all the time. And we are joined by our CFO, Crystal Lail, Vice President, Chief Financial Officer, and probably one of the smartest people, and I'm not blowing smoke here, probably one of the smartest people I get to be around when it comes to finances, world economics, and things like that. I would put Professor Crystal Lail up against any college professor with your knowledge and the depth and what I like about you, Crystal, and the listeners and viewers are going to see this, is how you can explain it down to people like me so I understand it. When we're dealing with the economics and the financial influences that we face at NorthWestern Energy in a company like this, the way you can bring it down so I understand it, that's an amazing trait. And congratulations and welcome to the show.
Well, thank you. You're very good.
Crystal, tell us your background. I think you've got a couple years on me. I've been here almost 20 years, and you've been in the energy business for how long? What was your rise through the business?
Sure. I started here, weird to think, January of 2003. So coming up on 22 years, which is almost shocking. I don't know how that happened, but in the sense of the energy business and utility business, when I took the job at Northwestern, it was an opportunity to come back to South Dakota. And it was at the time Northwestern Corp that had other interests, including the utility, but some unregulated businesses that are now a bit infamous, shall we call them. So when I took the job, it was more an opportunity to get back to South Dakota, a large company that's doing several interesting things, and maybe I'll work there for a couple of years and see how it works out. And boy, was I wrong about that. I can remember when I started the organization, of course, much younger and different perspective on longevity, shall we call it, than I have today. And I thought, gosh, if I work here for 5 years, that'd be a really long time. And then I started working on utility stuff kind of right away based off assignments and would interact with all these people that have been at the company 20, 30 years. And at the time I thought, how does that happen? They must not be interested in growing, learning, doing all these other exciting things. Good for them, but I'll be here for a minute, learn some things and then see where that goes. And here I am eating my words in a lively manner, having never been bored while I've been here. And almost hitting 22-year mark and having opportunities that I can't imagine. You certainly couldn't have planned when I walked in the door.
And I don't know if I have permission to talk about this, but we can talk about it because this is a prior company to really the company that I worked. And I get to use Brian Bird, our CEO's line. He coined it, and I've used it. That was before my time with the company. But you went through, on the financial side, some pretty big struggles in this company when this company emerged out as NorthWestern Energy. That had to be pretty taxing, but also pretty rewarding when you see where we are now.
Yeah, I always think when people describe their careers and the things that they didn't anticipate. I've heard lots of people say this, and it's incredibly true, that opportunity looks an awful lot like hard work in most situations. So my first year with the company, we filed bankruptcy. And prior to working at Northwestern, I worked in public accounting, which is a little bit it's known for when you come out of college, it provides a great kind of training, proving ground where you get to learn a lot. But you have minimum chargeable hours and they like to work you a lot. You have minimum work weeks that are like 60, 70 hours, that kind of thing. And it's meant to kind of, I think, narrow in the field, and you're young, so why not do it then, right? So I thought I had worked a lot before I started the company, and I didn't hold a candle to what kind of my first couple of years at Northwestern held in store for me. So your point of where Northwestern was at the time, and being involved in a company that files bankruptcy, which most people might think, why would I want to work there? Those kind of things. While it was interesting in the sense of the stability part of it and how long I might have a job, et cetera. The other side of that is I learned things that you would never learn having not gone through that experience. Now, I don't need another one in my career. So one was good, one and done. But the things I learned through that process were just invaluable. And I don't think you would have that same opportunity absent that set of experiences. So again, while you may not sign up for that in your career, it became a proving ground for me learning the business. And then fundamentally, the company before bankruptcy had acquired the T&D assets of Montana Power. And so my first assignments were, there was other parts of the business that had challenges, but it was to solidify the final kind of transactional work around that acquisition. And lo and behold, that became the foundation of relationships of people that are still in the company and that I work with on a daily basis today, working through that process with them, but also learning the utility from kind of the ground up as an accounting finance person. And my job was to scrub the balance sheet, which I know everyone's going to think is super exciting. But it actually was. You learn a lot that way. I always think the fundamentals of accounting will teach you a lot about a business, et cetera. And so scrubbing the balance sheet of what had become that acquisition was kind of one of my first assignments. And it proved to be a good one because it taught me a lot. But, it's also the opportunities are what you make of them. So the process of going through a bankruptcy really taught me many things and gave me an opportunity to learn the business that I wouldn't have probably had otherwise.
So I guess I go back to, and after that you became the controller. Was that in the teens somewhere like 15, 16? When was that?
I don't know what year that was, Tom. My years run together and my team laughs at me because I'm always like, it's roughly somewhere in there. So I think I came
before
in
COVID. I mean, we could say that, right? Pre-COVID.
There was COVID, and then I really got off
Yeah,
on my years.
nobody knows after that.
Yeah, I think so. I started the company in 2003, and I was an accountant. I don't even know what my first title was, quite frankly. And somewhere in there, I became a manager. For many people, I always think of the woman who was the very first person I supervised. She just retired last year. And that poor person, right? You learn a lot. And the first people you supervise. Anyways, then kind of had a broader scope. Then I became the assistant controller. And then I think I became vice president controller in 2015. I think that's the right time frame. And then CFO in 2021.
So when you make that move from controller to CFO, obviously a lot more responsibility, a lot more pressure, but it's been such an easy transition with the prior CEO with who we had in Bob Rowe. What an amazing man to work with. It's one of those things where that relationship of South Dakota, Montana, and Nebraska, Bob really brought all that, and just we had some other things in the company that brought us together, being the ice storm of 2005, which was probably about 4 months or 6 months after I started with the company. And it was really my introduction, the big ice storm in South Dakota, where pretty much every one of our electric customers experienced an outage, and we were bringing all of our linemen from Montana over to South Dakota to fix and restore, and it really did build a good family relationship. But I think the addition of Bob Rowe brought that even more together, just from both sides of our service territory, the East and the West. And do you see that in your role as the CFO to just kind of build on what Bob had already done in those things and what Brian had already done?
I think partly because of where I was in my career when Bob joined the organization. So kind of that process of you come out of bankruptcy, and then we were in play M&A wise to be sold. And then that died down. And then for a lot of reasons, fundamentally, the board decided to make a change and bring Bob Rowe in. So when I think of what's been instrumental in my career, Bob and Brian have been huge pieces of that. And obviously Brian is our CEO now, but he was the CFO during that era. But fundamentally, when you worked at the organization, obviously things were tough culture-wise in the midst of a bankruptcy, and then a lot of change. And to your point, Tom, on that ice storm of how people work together, different states, and how do you fundamentally get to the mutual, I think there's always a mutual respect, but truly feeling the camaraderie is a whole nother level, right? And I had that at kind of the lower levels, but I sensed above me that wasn't necessarily always there. So one of the things that's been striking to me from a leadership perspective is how Bob Rowe came in the door and took what, absent a couple of changes, was the same executive leadership team, and the tone changed immensely. So can leadership make a difference, and what's that like, and how do you feel it at lower levels in the organization? Bob was a wonderful example of that. But then also kudos to folks who were on that executive team that then took that leadership and adjusted, and we became a really fundamentally different culture, as Tom, you experienced too, and where that went, and really one unified team. You still have all the normal human stuff, and we will have conflict, and that's healthy actually, but what Bob did there in transitioning culture and creating an executive team that we all worked for at the time that was much more cohesive and together and moving in the right direction. And what that meant from an employee morale perspective was dramatic. So it's one of the things in my career that I will never forget. And having had the opportunity to work for both Bob and Brian is, you think about, I've my niece turned 18. She's a freshman in college this year, which is also shocking. And she asked me how I knew what I wanted to do for the rest of my life. Like, oh my God. All I knew at the age of 17, 18 is I wanted to leave South Dakota. So clearly I had that all figured out, which I did. But you ultimately don't know, and it's just make the right next step. And then also the opportunities to see good leadership right in front of you and see what difference that makes. And then hopefully have that opportunity to emulate it. That I feel very grateful for, and having had the chance to work with Bob and Brian, and then to your point, transitioning in that leadership transition has been, I think, as smooth as probably it could be in many organizations.
Brian Bird is a remarkable human being and is the only CFO I knew before you. Now that he's head coach and you're QB1 on the finances, do you get to go to the old head coach and say, how do I take care of this? Or does he leave you alone and let you figure stuff out on your own now that you're the CFO? Or is it so nice to have Brian a couple doors down and say, hey, what do we do here?
A little bit of both. It's kind of funny because Brian, if you know his personality, Brian goes after it. And many times I'm like, when he says he'd like something, he'd like it yesterday. That's my standing joke with him. But he's also a master delegator. So when he moved into the COO seat, he kind of went, I'm out and I'm going to let you do the job. And there was a lot of things going on in 2021 that I won't go down the entire road of, but I'm like, hey, Brian, we need to have a chat because to your point of in the sense of stepping into an elevated role, and you always, I sat right underneath the CFO seat for quite a few years. So I had probably the best vantage point to it that you're going to get. But I certainly couldn't have anticipated the true demands of the role or what it's going to be like. So having Brian around to constantly seek him out. So it was more me seeking him out, less him still invading in my territory. And he was, again, very good at focusing on what he wanted to learn on the operational side and letting me run on the CFO side. But it was interesting times just from a credit and utility perspective and how the environment was changing coming out of COVID and pressures from a stock perspective and the part of the business that, on the finance side had not been mine. So it created a lot of learning opportunity. But I can't think of a CFO that steps into a better spot to have a safety net under them of having Brian Bird still here. And then one of our board members in particular was a prior CFO as well. And to have both of them as my mentors and guiding, I think really set you up for success. And so it's like, how do you emulate that for others and creating opportunity, but also giving them, a chance to, you run fast, but you also are going to make some mistakes and need some advice. And I definitely have that in this seat. And it's been really wonderful.
And your community relations team in South Dakota, Nebraska. Amazing, right? So,
and a top-notch community relations team with lots of more relationships than I could possibly imagine, or probably.
That's numbers, I know people. That's about it. I want to go back to a comment you made about your 18-year-old niece or however old she is, and wondering what you wanted to do. And I love to know the DeSmit side of Crystal Lail. When you're at DeSmit High School.
Yeah.
What was the thought on did you ever think that this is somewhere where you wanted to go? I mean, you had to love math, you had to love a little bit of the socioeconomic type stuff, but what was that really drew you into from your schooling? What got you to where you are now? And did you know this is something that you wanted to do?
The short answer is I think it's rare that a 16, 17-year-old kid actually knows. There's a few that have a really strong sense of direction. My brother was one of those. I was not, but I did have a teacher in high school that, I took the basic accounting classes and I kind of liked them, but I didn't think I had any interest in doing that because I thought that would be boring. So my first step in college was where can I get scholarships and not have to pay much? And then step two is I knew I wanted to do something either in the business field or actually kind of biology, medical type thing. So when I signed up for my freshman classes, so when I went out of state to school, a small liberal arts school in Missouri, back to that part of I thought I wanted to leave South Dakota and never come back, which is no reflection on DSMIT. It's just the lack of maturity that you have as a young kid and wanting to see the rest of the world. So anyways, I had wonderful teachers at DSMIT who prepped me for all of that. And then I went to college and through a weird sort of serendipitous way, found myself into the business school and found people that gave me really good advice because my initial direction was not to pursue accounting or anything like it. And I had a professor that kind of stepped in and said, you clearly have a knack for this. You should go this direction. And it doesn't limit your horizons in any sort of way. It just enables them. So if you study something core and technical like that, you can choose to do any of these other things, but you're setting your solid base if you choose to study accounting versus these other things. Basically was telling me, don't limit yourself over here, study accounting, and then go off and use that as a base to do whatever you'd like to do. And it was really wonderful advice and meaningful in where I went from a career trajectory and all that sort of thing. But coming back to the DeSmith thing, small town South Dakota, very similar to small town Montana. I think the punching above your weight and the solid educational experience you get in these small sort of towns is just phenomenal. And you see kids who, either leave and come back to the farm or all these kind of things. To have the quality of education we have here, I think is pretty incredible.
Well, I know DeSmit, your teachers in DeSmit, I'm sure, are proud of you if you keep in touch with them. That's always kind of the thing I always like to do, is just keep in touch with those people that made you who you are. But let's talk a little meat and potatoes now. Sometimes we have this thing called Chautauqua, which is a kumbaya that Bob Rowe started probably 7 or 8 years ago, where we all get together and we company-wide kind of talk about a little bit of everything. And Crystal gives a 3.5 hour, is it?
Everyone would be asleep. I think it's 45 minutes to an hour, Tom. And I think it's meant to be 45 minutes. And I usually talk.
And it feels like 20 minutes. Let me just say that. But you go through and you just throw numbers out there. And I'm always dumbfounded as to what it costs to do business and how things have changed. Let's just start on capital. And 10, 15 years ago, NorthWestern Energy, the capital expenditure as opposed to what it is now, and interest rates and stuff. Talk about that just a little bit and what it looks like to do business in today's market.
Yeah,
trying to keep up. Yeah.
It's a fascinating world, and the demands on the utility sector. I try to, because I live in this world all the time, of seeing the outside viewpoint of, do I make an investment and put my money in a utility stock versus somewhere else? And that's certainly the transition to the CFO seat, where you have a much more external facing, and you're really talking about why it's important to invest in infrastructure and what that does to enable the states we're in. So if we're doing our jobs right, it will enable economic development and, not only reliability first for us, right, and affordability of our customers, but also the economic engine of the places we serve doesn't go around without us. But we need to do our job well to enable the future at the same time. So the dynamics of this space has changed significantly. So one, I think about this and the opportunities I've had is a little over a decade ago, I did this business acumen course, which is other utilities, et cetera. And the theme at the time was the doom loop of utilities. So everyone's going to continue to use less of our product, and yet our costs are going to either stay the same or slightly increase over time. And how's that all going to work out to where we sit today, which is, can we keep up with the energy demand in this country and fundamentally be ahead of the amount of electric demand growth and all of that, which looks quite different. So you got to attract infrastructure investment, which is where you're going on how much capital do we deploy and reinvest in the communities we serve and all those kind of things. So if you look in the late 2010s, et cetera, the company by and large would be less than 100 million of capital a year, which from a personal balance sheet perspective can sound like a really big number. But from a utility perspective, it's actually a very small number. To this year and last year, between 500 to 600 million a year. And I would tell you that's holding a lid on it. The engineers and how we think about risk and where we need to go to serve customers would say we should be spending a lot more. And there's many opportunities coming our way that will likely push up that 500 to 600 million a year to bigger numbers. So step A is how do you manage that and make sure ultimately every dollar we spend, we should be recovering from our customers and earning a return on. So you have a huge responsibility to A, when conditions are the worst, we keep the lights on. But then B, how does that affect customers and local economies and what you spend and provide a return to your shareholders? So the perspective of reminding our folks of that's a lot more spend. Now, certain things cost more, but fundamentally, we're doing a lot more on the grid and to serve customers than we were at the time. So you're spending a lot more, and at the same time, interest rates are maybe some people would say back to more norm. But when you had recency bias of a decade of low to no, 0 to 1% interest rate sort of stuff, where we could short-term finance, not long-term rates, but short-term rates were very low. So from a practical perspective, the example I like to give is, we have a revolving credit facility, which is how we fund every year's normal CapEx until we turn that out into long-term debt and seek debt investors for that. And that revolver used to be less than 1% interest. And now that sits at over 6% interest. And when you're carrying 500 to 600 million a year, the simple math says that that's a lot more expensive than it used to be. So just fundamentally how we run the business with those basic interest costs. That's what I try to bring in that conversation is
The interest is what
everyone
killed me.
understand just how much that one thing has had, but then also to think about even small mom and pop business has some sort of working capital and how they fund their business. And why are they charging you more? Well, just the interest part of that's costing them more to operate. And then everything you pay for has that baked in. So every piece of capital we do that we're procuring material from a vendor, they've got the same economic situation they're sitting in while labor is rise and all those sort of things. So it's helping people understand why A, we're having to go in and ask our customers to pay more frequently, and B, what's the broader business environment that just changes. Now, if you back all the way up in a 30, 40, 50-year history, you would see that interest rates in the 6 to 7% range are actually not all that high, but because we spent a decade of ultra low, it feels very high. So it's trying to help people understand that perspective. And then you always get reminded by some folks who are like, yeah, my first house, I financed at 18%. And then I think it's really crazy. And hopefully we won't see those days ever again. But it's how do you balance the needs of what we need to do, what that's going to cost, delivering that much capital investment on an annual basis, and do that in a way that holds the lid on costs. It creates quite the puzzle.
And Brian still likes to bring up the chart where the egg costs $6 now or whatever, and if you would do real true inflation, you're getting up to $18, and really electricity costs the same, which is, granted we've added a lot more customers to it, and that takes the price down, but the cost of doing business, I always tell people when they ask, what kind of capital do you guys look at? And I said, well, I'll tell you this: every transformer you see, basically $1 million. It used to cost $1 million to do 500 kV line for a mile. Now it's about $2.5 million. So everything has just exponentially gone up in the world. Steel, copper, all that, labor costs as well. So yeah, it takes a lot of money and it takes a balance. And that's what I think that you guys have done a great job of is keeping that balance and keeping rates down, because when I get to go out in front of people and talk about, what we get to do, some of the big infrastructure investments that we made and generation assets and things of that over the last 10 years, it's pretty impressive that our rates are still the same. You mentioned stock price. That's kind of the outward facing thing. We hover around that $50. We've been up as high as 70 in the past and down as low as 40. Talk about the stock price and why the utility stocks kind of mirror each other a little bit, and why it always kind of looks the same. Nobody really has a really great big huge. You don't see energy like electric provider stock prices, utility provider, because we're a dual. You don't see those prices really going up crazy. Like,
Yeah.
what does that look like?
There's been tight banding, but I want to come back to one thing before I go to our stock prices. Just fundamentally the cost of what we do. And just like you get recency bias on interest rates, you also get a bias as to what I pay today and paying more. Why do I have to pay more? And if you back all the way up and we look at it as wallet share, is how much of your income are you spending on your energy costs? And can people afford it? So we generally sit in the 2 to 3% range. For perspective, in Europe, they're somewhere between 30 and 40% wallet share for their energy needs. So when you think about what that does to the economy and contraction, so if instead of being able to take my family out for the local restaurant in small towns, keeping that economic engine going, or being able to buy new goods, new services, if you're spending 30% of your wallet share on just your utility and energy bills, that's going to have a massive impact on the economy. So that part of American ingenuity and what has kept that wallet share to what is affordable in much of the country. We will not refer to, I had a meeting yesterday, the Hawaii Electric CFO was on their rates, for reference, are sit in the 10 to 12 cents as we think about them. They're 42 to 45 cents. So it's just different in different parts of the country. So
not to mention a massive rebuild off of a terrible, disaster that they had there. So yeah,
the Midwest is a good place to be. I'll go with that. And the ingenuity that is went behind that slide that Brian uses of, what's happened with the ag over time, not much. What have we done on the grid, and customers are paying value wise, I think a pretty good deal. That's important. So you asked me about stock price. So when I became CFO in 2021, I think within the first quarter after that, we were over $70. And then I'm the CFO that presided over the slow, steady decline to $45. So what's going on there? And your question of, how does that compare to other utilities? So we always talk about, if you're going to invest in utility stocks, people invest in them usually for a couple of reasons. One is because we're dividend paying. So you get a return on that immediately versus stocks that you're just looking for price appreciation. But you'd like to see price appreciation over time as well. But you're also not going to see the type of price appreciation that tech stocks, NVIDIA, et cetera, have seen. But you also shouldn't see the type of risk that your value goes to zero. So it's a value stock. It's a long-term hold. You want a solid dividend. You want to get total return. We always talk 9 to 11% total return with a 4 to 5% dividend payout ratio. And the rest of that is stock price appreciation. So what has changed since 2021 to today is obviously, as we later in 21, the Fed realized they were behind on the inflation was not transitory and they needed to slow the economy. They could have stopped printing money, which is a whole nother topic, or you do other monetary policy measures and went that direction. So then interest rates rose in 2022 and the country has never seen anything like that interest rate rise. So how does that affect utility stock prices? Well, if you had a dividend yield of 4 to 5%, where most of us sit, and you could buy a utility stock, feel like it's very low risk, and get 4 to 5% on your money, kind of guaranteed. That felt pretty good until you could go to any old money market and get that. Then why take risk with a utility? Because then your upside is pretty limited. So utility stocks traded consistent with that. They're kind of bond proxies, which is if you can get that kind of return somewhere else where previously when interest rates were ultra low, you couldn't. And so you bought utilities as kind of that, I don't buy treasuries or other things when I can just buy a utility, get a dividend and see that kind of return. Utilities really became out of favor, which makes sense, right? So as the interest rates came up, utility stock prices came down. Most of us as an investor-owned utility traded publicly, and others trade in a very tight band against one another. So there will become differentiation. That differentiation is truly around the ability to grow, what's happening in your service territory, and your regulatory compact with your regulators. That's the two biggest things that are going to drive it. So our stock price came down substantially. It's come back up recently, which would, as the Fed began to say, we're done increasing rates and we're going to begin cutting, that's where you saw utilities begin to stock prices come back up again. So I do believe I'm in the camp of higher for longer on interest rates. But I do believe as you get through even 2025 and a little bit later, as interest rates moderate and maybe come back down, utilities will trade better.
When you talk about the future of stock prices and things like that, you have to think about the future of energy usage. And we talked about just the demand that there is for energy and I kind of remember those days back in the past when people were saying, oh, we're telling people to use less energy. Everybody's going to start using less and things are going to be more efficient and this and that. And all of a sudden we're plugging in cars and we're building data centers now. Talk about, put on your future hat, because I know you have one, and just talk about what this utility, we're trying to get to net zero by 2050. Talk about what that is even going to look like. From your seat, that's a lot of money going out the door to make things happen, to make generation happen. That's carbon neutral. and things of that nature. What keeps you up at night in that forefront? And we're getting close to the end, so you've made it almost this 30 minutes, Crystal. So I'm proud of you. But
Okay. Well, then
we're
I'll try
getting
to
there.
keep this,
What
I'll try to
keeps you
keep
up
this
at night?
answer
No,
somewhat
you're good.
short.
You're good. We can talk forever.
While I can't predict the future, I can predict a couple of things, and just size wise, like our market cap, 3.5 billion. You think the next eras of the world, like a $90 billion market cap, much larger. So those that are going to invest in and I think drive the technologies that will drive the future, it won't be us. We won't be the first of a kind on certain things. But your comment on net zero and decarbonizing. So one, factually, the thing that has decarbonized our economy more than anything else is natural gas. So the shale gas revolution, what that brought down from a pricing perspective and allowing the transition from an older fleet of coal that where it economically made sense to transition to natural gas, the decarbonization that has come with that was massive and very good for this country. So then you've done what I would call the easy decarbonization, because then the other side of that is how you balance intermittent generation and bring on things like wind. You can only have so much of that in your portfolio and maintain the reliability side of that. So if you think by 2050, we're headed toward net zero, and how do you do that in a cost-effective way? We're very clear that will take technological advancement that is not here today. But the next part of that is there's a group of very smart people who want more power. And you've seen recent deals with some large, I think Amazon, et cetera, to begin exploring nuclear, those sorts of things that would push us to a carbon-free future that has in it stability and all the things that we need. There are smart people putting a lot of money to figure out what is the next thing. So I do think as a country and broadly as an energy policy perspective, we will get there. But it's also, we want to be a fast follower, but we're not going to take on that risk for our customers on the front end of that of we've got to make good decisions. And Brian always uses the term, we're not going to destroy the old bridge before we build the new one. So we're going to be focused on, we're already more carbon free than all of our peers, except for one on the backs of our hydro system and a lot of wind in our territories. So then what's the next right technology that takes us to that real future? And the key is not making investments that will be stranded as of their time, I would call it. In the sense of how we get there. And I do think there's a lot of money headed in that space. The AI demands, if they're even half right, we will have to crack this code on new generation, putting more power onto the grid and doing it in a cost-effective, carbon-free manner. And then we will be fast to follow that.
And the crazy thing is we're not the only, every single utility in the world is having the same issue that we're looking at right now. And then you start to get in the log jam of this is the technology everybody's going with and who can get this built first. So Bob Rowe always said technology at the speed of value, but we almost can't follow that right now because we can't sit and wait. Otherwise we'll be behind the log jam. And that's why that's where Brian comes in with that kind of go get them and let's lead the way a little bit, but do it smartly and financially wise. Crystal, I appreciate you. I appreciate you taking your time. What does Crystal Lail do on her free time? Do you take any free time ever? Is there anything that you enjoy?
Time.
What makes you enjoy life?
What makes me enjoy life? I have a great family and great friends, and obviously that's the source of enjoyment. I have a wonderful, you guys know this about my dog. I became a weird dog person. I am that, but my husband and I spend a lot of time outside. I've got family nearby, immensely blessed to have that. Things like next week, we'll be hosting everybody for Thanksgiving and all this sort of thing. So that's the stuff that's fun to do. We also travel a fair amount and do other sort of fun stuff. But South Dakota is a great place to be. And I'm pretty blessed to be here.
I say all the time, we serve the greatest. When we get to go out to Montana and do work out in Montana, it doesn't really feel like I'm not at home. I love it out there, and I love it. South Dakota, Nebraska. We live in the best part of the country and get to serve some of the greatest people around and some of the very interesting businesses and do it all with financial stability in mind. And you've done a great job, and I appreciate your time on the show. Want to thank Lori Nelson. She's our executive producer. She's also in charge of wardrobe and lighting today. I think she took care of all that. So Crystal Lail, the CFO with NorthWestern Energy, thank you for jumping on the outlet. Thank you all for listening. Join again next time.
Okay. Thank you, Tom.
That's a wrap on this week's episode of The Outlet. For more information and weekly energy updates, like and subscribe wherever you get your podcasts, or visit northwesternenergy.com.